Good afternoon, everybody. David Grau, Jr., President of Succession Resource Group, welcoming you all to our session here today. So I'll give you a little bit of background on Succession Resource Group. We are a consulting organization dedicated and focused on the financial services industry. We only work with independent advisors, although the sort of box around defining that has continued to expand over the years. We still keep a pretty narrow focus, though. So independent financial advisors, we'll work with independent insurance agents as well as tax professionals. And frankly, again, the lines between those oftentimes get a little blurred depending on the practice. But again, financial services industry is and has been our focus. Our role, we help folks with, which you'll see on the right-hand side of this slide, everything from valuation, growing, all the way through your eventual exit. At the end of the day, short version, this is the last bit of the commercial for you. When the time comes and you're ready to engage with valuation or succession planning, succession exit planning being the topic of the day here, you'd hire us because we deliver a comprehensive solution. We've got all the expertise and skills in-house, as opposed to you constructing your own team, getting a halfway decent coach or consultant that maybe knows a little bit about M&A, and then going and finding an attorney who knows, well, one who knows securities and advisory, one who knows M&A, assuming that that's the subject matter, and then trying to find tax counsel to help coordinate all that. And then you get to be the quarterback or field marshal. So we just bring all those disciplines together under one roof to deliver a well choreographed, well integrated solution. Frankly, it just lets you sort of look over the shoulder of your peers and see what has worked well in the past and what hasn't. We work on lots of deals, hundreds and hundreds of evaluations every single year. And frankly, that ends up being the jumping off point for our work together. So as we get into the content here today, let's hit the agenda for today. We're going to lay the groundwork on things that you should be thinking about and doing, well before you ever contemplate actually selling. So this is the very proactive, prescriptive steps that, unfortunately, even in an industry full of professional planners, we never seem to have enough time to get to these things. So we're going to touch on that. We're going to hit managing the actual sale, contemplating internal versus external, and things to be thinking about during that process. Not, I don't say the boring minutia because it's what we get paid to do, but not getting into the specifics of the contracts or the negotiations or how we get to a purchase price. We can help you with all that. This is about sort of the other fundamental components that oftentimes get overlooked that we want to make sure to highlight for you today. And then items 3 and 4 are sort of related, but we're going to tackle them independently. And that is the actual transition considerations and then post-transition or post-sale key points to consider and make sure you do not, in fact, forget about. So going through all this content here in the next 35, 45 minutes will be myself. I'll obviously kick it off because I'm talking currently. But I'll hand it over here very quickly to Kristen Grau, our head of listings. She does a lot of work around helping advisors who don't necessarily have an internal succession plan, list their practice, find great buyers, screen and negotiate deals. And so basically, she put together the slides and we'll be able to share some real world insights into the things that she sees happening on the back end that would be so much easier on you as our client or potential prospect if we could have just started the conversations earlier. So she'll give you some tips, takeaways, and if nothing else, plant the seed, sort of get the gears turning so that when you're ready to exit, that you do end up getting the best buyer, the best fit, and then depending on your priorities, the best terms and best price. It is possible to get all of those, but it's not easy. So with that, let's kick things off here. And Kristen, I'll hand it over to you initially, and you can talk about the kind of fundamental groundwork that, again, gets, I don't say skipped so often, but frankly, there's just oftentimes not enough time to tackle it. So anyway, all yours.
Thanks, Stephen. First and foremost, we know that if you're on this presentation today, that you may be contemplating selling your practice, and that is not a decision that you or we take lightly. So before you make the decision to ultimately sell, it's important to lay the groundwork to ensure you can sell the practice on your terms and with confidence. So what we're going to do is we're going to discuss 5 critical steps that you should take before selling your practice to result in a successful exit. Dave, if you don't mind advancing.
You bet.
And these steps aren't just about getting your business in order, they're about optimizing your business's value and ensuring a smooth transition. So planning early is truly the name of the game. First up, you have to optimize your business. Optimizing your business involves making it attractive and efficient before bringing it to potential buyers. So, what this means is making sure that you have recurring revenue streams. Obviously, buyers are going to be more interested in a business that offers predictable recurring income. So, it's vital to review how much of your revenue is truly recurring. But more importantly, there's additional areas to consider reviewing, things like ongoing advisory fees. Are your fees in line with, or excuse me, have you reviewed your fee structure recently with clients? Are they in line with industry averages? Do employment agreements with your staff include restrictive covenant language to help protect your book during a transition? Are you utilizing your current tech stack in the most efficient way possible in an effort to transfer information about your clients to a buyer when the time comes? Step two is knowing your numbers, and I truly cannot stress this enough. Obviously, you need to do your homework and you need to know or should know industry averages. We have an M&A review that we do each year. It dictates or shares with you current multiples, both on a recurring revenue basis as well as an earnings basis. It indicates average trends in terms of deal structuring and taxation. Understanding that is step one, but also you need to spend the time and money to know your own numbers. You can't, or really shouldn't, sell your business without understanding exactly what it's worth and where its financial strengths and weaknesses lie. You should have a solid grasp on the value of your firm, not just before you're ready to sell, but early on. So, valuations, I think it's a misnomer that valuations are only done maybe prior to exit, and that couldn't be further from the truth. Really, they should be done early and consistently to ensure that you don't just have the information you need, but that you have the time to do something about the information that you receive. So, getting an annual evaluation is truly key to having a strong financial health and knowing how your business compares to those around you so that you have the leverage that you need during negotiations. Step three is planning for your transition. It's really important for you to understand your goals and what your role is going to look like post sale to ensure that you get what you're looking for and that your business continues to thrive. For example, are you going to exit immediately or do you want to stay on for 5 more years? Are your staff crucial to a successful transition? What happens to your office lease? Ensuring your goals are upfront and transparent from the beginning will help ensure a smooth sale when the time is right. Step four is preparing for due diligence. Due diligence is one of the most important parts of selling your business and oftentimes where things get held up. And ultimately, where a lot of deals can fall apart. Essentially, the buyer is going to want to dig into every single aspect of your business to ensure that everything is as it seems to be. Your job as the seller is to prepare all of your legal, financial, and operational documents in advance to make sure that this process is as smooth as possible. In my experience, the firms that have an abundance of due diligence materials tend to be the ones where the buyers really don't feel the need to dive deeper and deeper and deeper. But the firms that have sporadic or lackluster due diligence materials, that's when the buyers want to dive deeper, right? Because it just seems like maybe they're thrown together or not accurate. What this means is providing third-party reports of revenue, AUM, and client demographics from broker-dealer reports or custodial reports. It means providing current and historical financials, reviewing employment agreements, and making sure that all of your regulatory and compliance documents are up to date. Again, the more transparent and organized you are, the smoother that due diligence processes can go, which will result in fewer roadblocks during negotiations. And finally, step 5 is to evaluate your exit team. To successfully sell your practice, you need a strong team of professionals by your side. You should consider a sell-side advocate experienced in the sale of financial services businesses like SRG, who can bring in other professionals like your broker, dealer, or custodian, your attorney, your CPA. We're not saying that these individuals don't have value. They do. They offer very specialized advice that can help ensure that the sale goes smoothly. But what we do is we help quarterback all of those professionals so you have one team and you know when and how to bring in that team so that you have a successful selling process. Now that we've covered the 5 essentials to getting your business ready for the sale, I think it's time to take a closer look at 3 specific areas that you can review and fix before you sell.
And since I had to control your slides, I'll pause here. I had a quick question for you on your first 2 points. You talked about fees, financials. What are your thoughts on timing? Because I know I've heard you talk about this with sellers before, where their fees are maybe a little bit below market. Would you suggest before they, list their practice with us or engage in the succession plan to take and ratchet those fees up? Or is that something they should wait to do after sale, years before?
Yeah, great question. A lot of times, and this is the importance of honestly an annual evaluation, is that if a lot of times if you make knee-jerk reactions like increasing your client fees right before the sale, you're not going to see the benefit of that increased fee in historical revenue. And so it's not going to be documented or proven that it can happen or that it can be sustained. And so if you 2 months before a sale, start ratcheting the fees up, you're not going to get the value of that fee increase. And in fact, it could result in clients leaving, right? Depending on how drastic that fee increase is. So increasing fees is really something that you should be reviewing regularly, which we talk about in an annual evaluation as an example. And it should be something that you do 2 or 3 years before you plan on selling your business. Alternatively, if your fees are lower, that's still okay, right? It just means that there might be more opportunity, and there's some safeguards that our seller advocacy team in particular puts in place to make sure that a buyer doesn't come in and drastically increase the fees, resulting in client attrition, right? Which could have an impact to your bottom line. So there are ways that the fee structure can be accommodated, but it's really important to Dave's point, to time certain changes to your practice appropriately. And our valuation team is really good at helping you do that.
Yeah, okay. I imagine internal succession planning, you get a little bit more leeway, right? Because you're not going anywhere. It's a gradual transition versus to Kristen's point, if you're going to sell it to a peer, whether it's your fee structure or even your P&L, don't get in there and start making wholesale changes right before you list your practice or sell it to somebody else, or they're going to do a lot more due diligence. All right. So anyway, back to you, Kristen, on those 3 items you had recommended.
Perfect. So the 3 items that we think that you should focus on fixing before you sell. First, documentation and cleanliness. As I kind of mentioned before, this has to do with due diligence, right? So make sure that all of your records are up to date and organized. This includes tax returns, financials, client reports, and governance documents. So often we will have sellers who are trying to sell, the buyer's trying to get a loan, and guess what the lender asks for? Governance documents, which are now out of date. The minutes aren't updated. Essentially, you're piercing the corporate veil in many instances. And once again, right, you're deadlocked. You can't move forward until those items get deadlocked. Or excuse me, those items get corrected or fixed. So we have an annual entity maintenance program that I would highly encourage you to look into if you have an entity. It helps you make sure that your governance documents are always up to date and that you're always in compliance so that hopefully you're protecting yourself and you might see a little bit of tax benefits or business strategies put into place. Ultimately, like I said again, potential buyers are always going to scrutinize your business. So having clear, accurate accounting, client records and entity documents that are up to date and accurate are essential. And then addressing any inconsistencies with any of those documents before the due diligence period will help prevent unnecessary complications. Another item that we suggest that you fix before you sell is improving or correcting operational inefficiency. In other words, being operationally efficient. And so what that means is streamlining your processes to reduce waste and increase profitability. Buyers are looking for businesses that run smoothly and require minimal intervention. So the more efficient your operations are, the more documented you are in terms of standard operating procedures or SOPs, the more attractive your business becomes. Lastly, try to reduce your personal brand. Oftentimes, if you are a sole proprietor, this isn't always easy and or even doable, but the trick is, again, trying to create those SOPs to standardize client processes, providing tools or building tools that document maybe when certain clients are seen or how they're seen, documenting what that client relationship looks like in a CRM system so that when you do transition the book of business or your firm, buyers know who your clients are and they feel more comfortable with how you've treated your clients and can facilitate that with a smooth transition. By focusing on these three areas, clean records, streamlined operations, and reducing personal reliance, you're going to increase your business's value and appeal to more potential buyers, often resulting in an increased value. So now let's talk about something that often gets overlooked, which is the emotional toll of selling. And here I have four key components that I want to address that I think will ultimately help you both prepare yourself mentally and emotionally for what's ahead. First, I think it's very important to acknowledge that selling your business is not for the faint of heart. I don't want to say that we have a lot of sellers who don't make it to the finish line because that's not completely accurate, but we work really, really, really hard to make sure that sellers take the time and attention of selling their business because it is essentially like a second job. And to do it right, you need to make sure that you're treating it as such. And so that's going to require a lot of decision making. It's going to require, time outside the normal 8 to 5. And at times it's going to seem overwhelming, but that means you're doing it right. And so selling your practice means you're stepping into a new chapter. And with that means that you can bring in a lot of uncertainty. It's completely normal to feel anxious about what comes next. The key here is to plan ahead and work with an advocate like SRG who can help you evaluate the candidates, establish a process and timeline, help address your questions proactively so that you can help reduce that sense of overwhelmingness and walk into your future with confidence. Obviously, there's going to be a sense of loss of loss or a loss of control. Many business owners struggle with letting go of something that they've worked 30 plus years to build. Sometimes it feels maybe like their first child. But I think it is really important to remember that selling doesn't mean giving up complete or letting go completely. And we'll talk more about different exit strategies later in this presentation. But the importance here is that when you think of selling your practice, I think it would be important for you to try and reimagine what your future looks like by maybe staying in the business, doing what you love and avoiding what you don't, right? or spending more time with family, pursuing new ventures, or even potentially taking the time off that you've always wanted. So don't think of it as this loss. Think of it as reinventing the future and new opportunities. Now that you know some of the groundwork that you need to be successful, David will discuss how to manage the sale and choose the right successor.
Perfect. And we had a question that came in while you were talking, so I will address it here real quick because I think it's topical for the group, frankly, and it builds on what you were talking about in terms of preparing the practice, cleaning up your financials, being ready for due diligence. So the question, if you're not looking at the Q&A panel, are most buyers looking back 3-ish years at financials, trends and organic growth, et cetera? So short answer is yes. I mean, it's going to be, there's the last 12 months. Well, there's the last quarter, for example. There's the last 12 months, last 3 to 5 years, and they're going to look at all of the above, right? Anything beyond 5 years isn't going to be terribly informative or helpful, but they're going to put the most weight on the most current trends, right? So the last quarter, the last year, that's going to be where they're going to focus, 60, 70% of their time and attention because it's going to be the most indicative of what they can expect next year. But they also want to make sure that they are looking at, previous year trends. Not that any of you would do this, but on occasion, folks get the bright idea that, clients really develop a need for these, fixed annuity contracts that pay upfront commissions right before the advisor's ready to sell. And so the last 12 months might look solid, but it's completely incongruent with the last 3 years and 5 years. So it is about looking short term and long term. And I'll come back to you, Kristen, on one of the things that wasn't asked here, but I heard you mention it. And I feel like I hear sellers struggle with this all the time. Buyers are going to do due diligence and they're likely going to ask for tax returns, right? So be prepared to provide those. Any reason why that is either A, such an issue for folks, or B, I mean, is that a consistent thing that buyers are requesting? Like, should sellers plan to be sharing their tax returns?
Yeah. So I want to hit on the question and then I'll hit
Yeah,
on
it's
your statement. So 3-ish years of financials probably isn't going to be enough.
sure.
Because again, you want to see revenue growth rates in particular. So if you only have 3 years, you're really only getting like a year or two max of revenue growth rates, right? So that you can compare how revenue streams are growing year over year. And that doesn't necessarily count for dips or um, strengthen markets or what have you. And so 5 years is typically standard.
Uh,
Um, Buyers and buyers lenders in particular will for sure request tax returns for 2 years. It's just standard practice. The reason why some sellers, I believe, don't want to share their tax return is because they feel like, I'm not the one getting a loan, so why do I need to share my tax return? And I think that that is valid, but if you want to sale and you want premium value, you need to go through a lender 9 times out of 10, and the lenders will require it, whether you like it or not. Where I think some sellers maybe feel it's an invasion of privacy is like, gosh, what if I have real estate or I don't want them to see what I'm
Right.
paying myself? That's irrelevant. That's perfectly fair. They're not requesting your individual tax returns. They are requesting your business tax returns. So I think that that's an important distinction. So if you have an entity, right, then you're going to provide your 1065 or 1120, 1120S. If you have a sole prop, then you could potentially just need to share your Schedule C. So there is ways to kind of get around this quote unquote invasion of privacy if you don't want to overshare all of your information. And that tends to be the one struggle some sellers can't seem to get over.
Okay. Yeah, that makes sense. And frankly, I mean, it's not that you necessarily even have to give the buyer your tax returns, right? I mean, they may ask to see them, but the bank can do it and they can request it directly from the IRS. So it's not getting posted to Facebook or anything. It'll still be, very confidential. So to Kristen's point, let's hit on the actual deal components here, things to be considering during that process. So She also mentioned, plan to give, 3 to 5 years, 5 years being more preferable. Again, if you're doing internal succession, less considerations on this because again, your buyer is going to be internal to the group. So a little bit different, but peer-to-peer deals or listings, then yeah, for sure. And that is a consideration. I mean, right? All of us need to think about, when the time comes, do we want to try to sell internally to your existing team or the team that you're building? Or you got a great lifestyle business, you don't want a team, you don't want partners? Well, great. Then let's look external. Maybe you've outgrown your internal team's ability or desire to buy your business and we need to look external. So there are the two different options, but they do necessitate, right, different people. Do an internal sale, we're going to need bodies, and we're generally going to need 2 to 3 next gen advisors, leaders for every one founder who's exiting. And we're going to need more time, right? You'll see on the slide here, we put in rough guidelines, but this is about as wide as those field goal posts are going to get. On an internal sale, we need 5 to 10 years. When I said we collectively need 5 to 10 years. And that's not from hiring the person, right? That's from finding the person, bringing them on, having them on board long enough that you decide, you know what, this is part of my succession plan, and then hiring us. So there's a lot of sort of micro level succession planning happening inside your office before you ever show up on our doorstep. And then when we get a chance to start working together, we can begin the actual succession planning process of role transition, financing, taxes, what equity do we sell and when. That's that 5 to 10 year period. So can it be done in 5? Yes. 10's optimal. You don't really need longer than 10. I mean, we'll take it for sure. But if you can give yourself even 7 to 10 years in most cases, big firm, small firm, I know those are relative terms, but I don't care if you've got, 2 or 3 million in revenue or 10 or 15 billion in revenue. 7 to 10 years is enough time from having done nothing succession related to having a plan in place and you being able to retire. 7 to 10 years is enough time. 5 to 10, we can get it done. Any less than 5, and we can still do it. You just have a lot less options, and it's going to be a lot of work in a short period of time. Externally, it's just a little bit easier, right? You can do it in as little as 12 months. I mean, shoot, Kristen, you've got deals that you've closed in less than that. Again, they're usually kind of fire sale situations, but I would say 12 to 18 months, pretty comfortable pace. And need longer than that, and you're just going to create even more continuity for the clients, which I'd put in the win category. So what are the ways to structure these deals? Well, again, I'm not going to go too far down this rabbit hole because there's lots of ways to structure a deal, right? But these are your big categories that are most common and used in 90+% of the deals that we see and or work on. So I'll hit each of these real quickly here, just so you've got some context for what I'm talking about. Because these are options to some degree for most of you listening. So there's sell and exit, and that is cleverly named because it is describing you selling and then exiting. So it's not an immediate exit, right? If you sell the practice today, it's still going to be probably that 12 to 18 month transition window. But that 12 to 18 months is just you introducing the buyer to the clients, the buyer to the staff, and giving your ringing endorsement of how amazing he or she or their team is, which presumably is a very true statement because you picked them. So it's still a lot of work to transition something you've built over 20 or 30 years in 12 to 18 months, but I would tell you it is doable. Retention rates are still consistently north of 90%. Give yourself a little bit more time. You can do sell and stay, where you sell and, you guessed it, you stay. You keep working on a part-time basis. Now, can you sell and keep working on a full-time basis? Sure, but you're only going to get paid on a part-time basis. I mean, we need the cash flow, right, to make these deals work. And most of the time, if you're selling, you're handing off like the HR and the operation. You're handing off everything except for the 1 or 2 things you actually really like doing. So the sell and stay works really, really well if you have enough time, where in most cases you would be selling the business now. We get the buyer lined up, they purchase the business, the whole thing, and then they hire you back on for 2 to 3 years. Wouldn't be uncommon. If you've got a really good fit and you're doing something you really enjoy doing on a very reduced basis, you could be here 4 or 5 years from now. So sell and stay works really well. The nice thing here is if you do have that additional time, you start the process early enough, when you sell the business and give yourself a 2 to 3 year transition window, even on a part-time basis, that it makes it feel to a client more like a merger, right? Because the team got bigger, not smaller. And yes, you communicate that you will be phasing out gradually and retiring eventually, but the retention rates here, I mean, oftentimes you actually see growth. And you could be at 110, 115% of the revenue or AUM a year after, as opposed to losing a small percentage in the sell and exit. So both work, both are options, just one takes longer than the other, right? Fractional interest sale is it's the ability nowadays to actually sell off a small stake in the business, 20, 30%, to maybe your eventual successor, but you maintain control and they become almost an investor, for lack of a better term. So there is the ability, again, it takes longer. You need to make sure you've got your ducks in a row. I mean, you need the entity, like the right LLC, S Corp structure to make this work. But you can sell off a fractional interest. They buy in, you start working together, and it gives you a chance to take some chips off the table, but not fully exit. Partial book sale is akin to that, but a little bit simpler in that you sell off, for example, the C&D clients. Now you think, well, who's going to want my C&D clients? Well, either A, nobody, or B, you're looking for a PhD. You're looking for, younger advisor who is poor, hungry, and driven. They're up and coming. They've got room and capacity. They would love your C&D clients because to them, they're clients. They don't have C&D client definitions yet. They just take good care of every client they can get. Also, even the folks who don't necessarily want your C&D clients, like that's not their target, well, they do want your A clients and they would like the B clients. They'll do the deal for the C&D clients to audition for the A's and B's in a few years when you're ready. So it does actually still work. And you'd be surprised how much interest there is. Also, good buyers nowadays, they have the same Pareto's rule of 80-20, where 80% of the revenue is coming from 20% of the clients, but they can still profitably serve the other small percentage that does not generate much revenue. So your C&D clients in their model, it actually still works. So partial book sales, it's a nice way to exit because as you reduce your workload, you can make sure your client service model doesn't suffer. Then there's succession planning. I mean, this takes a lot of different shapes and sizes. It's what I talked about with that 5 to 10 year window. But if you have an internal team and or you're building that team out, there's a number of different ways that you can exit on an internal basis and share your equity. There's lots of different types of equity. You've got phantom equity or synthetic equity, where you do a lot of those plans. There's real equity, but even real equity, if your entity is set up correctly, i.e., if you worked with us, for example, we can make sure that your LLC, you've got full equity rights, non-voting, and value rights. We can give you different tools where you could get more comfortable sharing equity earlier and actually start to create a little bit of a career track. It's pretty cool to see, but it does take longer. And then the last one I'll mention, and I hesitate to even label this a merger or an exit strategy, is the merger. But it is a pathway to an exit strategy. But keep in mind when you think about mergers, if you were contemplating retiring in the next 5 years, do not do a merger. Unless you are just a glutton for punishment and want the most stressful last 5 years of your career, give yourself more time. If you got 5 to 7 years or longer, a merger can be a good option. But the problem is it takes at least 12 to 18 months of dedicated time working together to really integrate your systems, your processes, your people, your client bases. And I'm being optimistic that it takes 12 to 18 months because remember, you still have to run the business in the meantime. So realistically, you probably, once you have merged and assuming it works well, and it doesn't always work well, but when it does, you're talking probably your 2 or 3 best case scenario before you finally sort of hit your stride and can see the benefit of having merged. If you're going to retire in the next 5 years, well, then you basically have a year, maybe two if you're lucky, of being merged before you then exit. It's a lot of change in a short amount of time. So mergers work well, but you definitely want that 5 to 10 year window, not the 1 to 5 year window.
Hey Dave, we have a
Yeah.
question from someone in the audience, and it says, after you identify a buyer, would it make sense to do a merger for a year before jumping into the complete sale?
Oh, I mean, academically, I guess, sure, but man, does that sound risky to me sitting here as, let's say, your M&A consultant, right? Because a merger, I mean, however we term it, it's an economic marriage of sorts. And to merge your business with somebody prior to completing a deal, it's a lot like moving in together before we get married. And no judgment here, but when you hit rough patches and we're not married, I just get my shit and I move out. Well, it's the same thing here when you're talking about merging together to see if you're a good fit. By the time you figure it out, you have so disrupted your client base and business that you better have enough time for the dust to settle, regroup, get some counseling, and then revisit this again. So I would say no. If I'm in your shoes, I would focus on spending a couple of months or really dedicated focused weeks on doing due diligence on each other, get to know each other. I mean, it's part of like our listing and advocacy process, but buyers do it, peer to peer offline as well. Before you get the deal done, make sure you've got a fair amount of confidence. The other thing is, it's all about the deal structure. If you feel like you've done your due diligence, you've got a good fit, and the deal gets closed and the buyer's paying you 70, 80% of the cash up front, they're going to make it work. They have a lot of financial incentives, riding on this. They have a bank loan that they need to get paid back. I mean, they're very committed. But if you focus on the fit, which is a good segue, because I want to talk about evaluating buyers and the potential fit, then by the time you're done with that due diligence, and I get it, it would be nice to have 12 months, right? To work alongside each other and see if we like working together. But in reality, you need to evaluate a couple of core things. This doesn't need to be your bestie. You're not moving in together literally. You're going to work together for 12 to 18 months, hypothetically, and then you're going to retire. So, but it does go back to then the content we have on this slide, for example, like evaluating buyers and not on the financial considerations of like their purchase price. It's a factor. I get it. But before you commit to that, it goes back to, I think, Lucy's question here, and that is we got to feel comfortable signing on the dotted line and not just hoping that this all works out. So it's about evaluating. You'll see the things we highlighted here, the cultural fits or that wow factor, making sure that there is good continuity between you and the buyer, but more importantly, the buyer and your clients. I mean, again, if we're talking internal succession, presumably you have this, right? Because you've trained and mentored your team. If it's a peer, we need to kick the tires on this. You know, value alignment, how we take care of clients, the reputation of the firm. Like look at Google reviews. I mean, talk to them, get to know them. Look through their client service model. Capacity is another one, and I know that sounds obvious, but you'd be surprised whether you're listening today as a buyer or a potential seller at some point. There are so many buyers that we talk to that I see, Kristen, you guys doing interviews with for listings. And, it's what, June 25th? You'll reach out to a buyer who's been trying to buy a practice and tell them, hey, we got your inquiry for the most recent listing. On paper, it seems like you're a really good fit. Would love to set up a phone call to discuss it further and then introduce you to the seller. And the buyer replies back and says, great. Well, got a bunch of client meetings coming up and then we'll be out of town for a week. So looks like July 14th or 15th would be my soonest. Swing and a miss. You're not going to have anybody to talk to by July 14th or 15th because the buyers who are serious have created the capacity. It's not easy, but as a seller, you want to make sure that whoever takes over your book of business, whether it's 60 households or 160, that their team have the ability to actually take care of those households, right? It's kind of a core fundamental component of you picking a successor is we got to like each other, but you have to have the ability and the time to be able to take good care of my clients. So just keep that in mind if you're a buyer listening. The seller's interactions with you early on, it's their first experience, and it's going to be their proxy for how they're going to assume you're going to take care of their clients. Which gets back to things like the service model. Evaluate the service model, make sure they're generally congruent. Or that at the very least, the buyer's model is maybe even an upgrade, right? Because I mean, usually the buyers, I think in most cases are, one and a half, maybe twice the size of most sellers. So hopefully their service model will give you complete confidence that you can tell your clients, you might like this actually, you probably won't say it out loud, but the clients will probably like the service model a little better than what they were used to getting because you're in retirement mode. Last couple here, the work ethic. I mean, this one, hard to evaluate, but you want to make sure you look at their experience, their credentials, and generally, I mean, if you're used to working, 40 or 50 hours a week, taking great care of the clients, managing the investments, and you pick a buyer who works part-time and they wear t-shirts, to the office, and that's just not congruent with how your clients or staff operate, doesn't matter what the price is, doesn't matter what the terms are. So capital is another one. This, again, I don't want to talk about evaluating based on price, and this isn't, but you do need a buyer who has the ability to get access to the money, right? If they can't get access to the funds, I don't care how good of a fit is, there's enough demand in the industry currently. You can find a good fit that can also get the money, which goes back to the size. If the buyer is half your size, they're going to have a tough time getting the money unless they got a rich uncle. And last one is just look up regulatory compliance stuff. This is an easy one. In our industry, at least speaking to the advisory and security side, look them up on BrokerCheck, look them up on IAPD, just see if there's, the fun Christmas tree looking at the timeline. Do your due diligence.
Another question came in. It said sellers have many choices today, private equity, aggregators, and individuals. Any guidance on how to filter through the best alternatives? And I'm going to take this and I'll let you add, but ultimately it is don't filter. Using our seller advocacy service, which I really think is the best out there, obviously biased, but we don't filter. We bring all of the players to the table and we look at all of the strengths and weaknesses of all of the parties so that you can ultimately compare and contrast each one based on AUM, team size, designation, office locations, number of owners, number of staff that are licensed and or unlicensed, how long staff have been in the business or not, the client service model, whether they have, a board of directors or an investment team, how they do their models, whether they're custom or if they're using modeled portfolios, how many modeled portfolios are they using? The list goes on. So I would say don't filter prematurely at all. Take a look, really try to vet each of the candidates, which is very hard to do if you're trying to take a DIY approach, I would say. Um, and then based on that, you can compare and contrast and then have conversations with some or all of them if that makes sense to you. And then based on, what you know of the firms and the conversations, you'll start to figure out what the best strategy is for you and what the best successor is going to look like for you. And that's going to vary from seller to seller. Dave, your thoughts?
Yeah, fair. I mean, it is nice to evaluate all of them. It's also, again, go back to what I still have up on the slide here, and that is evaluating the buyers and your preferences and priorities. I feel like having, I get to go out to a lot of the conferences and talk to advisors after I'm done presenting. And when I'm talking to folks and they're describing who their ideal successor buyer is, they're describing themselves just 20 years ago, right? I mean, I don't know that I've ever had anybody say, my ideal successor to buy my business, and I don't care what your size is. You could be at 5 billion or 500,000 in revenue or AUM. No one's really ever come up to me and said, you know what, I'm really working to get this thing built up so I can auction it off to private equity to make an investment. But it does tie into one of the other questions I saw come in, and everyone's putting anonymous attendee. It's hard to reply to you guys all by name when it's anonymous every time. But it's another question around the size on succession planning, and it ties back into your choices as a seller. For internal succession planning, you know who your successors are, right? If you're looking external, then sure, maybe private equity aggregators or individuals are all options. But my guess is if we ask you who or what your ideal buyer profile looks like, you're probably going to have an answer to that question. Number two is it's dictated by size. Private equity is not going to be a viable option for the vast majority of the industry because they're not going to be seriously looking at and or making offers you'd consider until you're probably north of a couple billion in AUM. I mean, they'll talk to you below that, but their offer is going to be so bad compared to what you could get from your peers that it would be laughable for you to accept it. As you get to the bigger sizes, 5, 10 billion and above, now we can seriously consider private equity. But below that, it just isn't viable. Aggregators will start to move downstream, but even they're generally looking at, kind of bigger firms, a couple hundred million in AUM. So it could be an option depending on your size. It also depends on just your preferences. The vast majority of folks, they want to sell to another peer group who's big enough to take over their firm, but not so big their clients are going to be a number. So take that for what it's worth. The other question I saw come in on internal viability for succession and the size of the firm. That one's tricky. I would say really it's probably more about size on the lower end. Anything below, a million, 2 million in annual revenue from whatever sources, it's gonna be tough to do succession planning, right? Because succession planning internally anyway, it takes headcount. We need bodies, we need people in a team. And if you're $1 million producer, you probably have a really good practice, but you probably don't have a lot of internal, junior advisor team members because you just don't need it at that size. So and then you can go the other way with it. Yeah, where you start to get up into the, 5 billion and above. In theory, succession planning works even better at those sizes because we have so much capacity and headcount. But there are a number of firms that they've outgrown their internal team's ability to acquire. Like there's not enough team members and they don't have the financial wherewithal because we've waited too long. So there's definitely a sweet spot. I'd say, sort of the 2 million in revenue up to probably a billion makes internal succession really, really easy. Above a billion, and it should be easy if we're being very proactive and prescriptive with it, but that doesn't always happen. So, all right, let's wrap things up here with my portion. I'll give it back to Kristen, and it's the inverse of this last slide. It's the risks of choosing the wrong successor, and these are things you generally know, but it's still worth reiterating because there aren't any do-overs. There's no reset button here, right? Like you're going to sell your business. You get one shot at doing it. Kind of like a divorce. I mean, maybe two shots, but you don't get any more than that. You're just not going to have any clients left to even sell. So it's important to spend the time on the front end to either let us evaluate those buyers, to train your internal team, or you evaluate them, because the risk of rushing and doing something and having a misstep. I mean, you can see the examples here. You've got the tarnished client relationship. Like even when the clients stay, if I was selling my business to Kristen and then it turns out we just doesn't work out as well as we'd hoped, and I end up separating from her a year later, I mean, I'm still here, so I'm going to keep all my clients. But you know what I can't do? I can't turn around and sell it to somebody else, a month or two later. Or there's just so much instability that's being construed now by the clients. So it changes your timeline. You may lose some clients in that process. You definitely can't turn around and resell it for the same value right away. So it just has such an impact. I mean, not the least of which is the emotional drain on you, your staff, your clients. So it's a hard thing to quantify. But if you can get the right fit, you, we, however we get there, I mean, it will pay off in so many other ways that you frankly just oftentimes don't even see because you never had to experience it. So let's shift gears and just continue the conversation now on key transition considerations, things you should and shouldn't do. Kristen, all yours.
Yeah. So once you've found that right buyer, you've negotiated the terms, you need to think about how you're going to transition the book, the practice, the firm from you to the successor, right? And how do you do that successfully with long term success for your clients, your staff, the buyer, and ultimately your legacy? So let's take a look at some of the key takeaways to accomplish a successful transition. I have some do's and don'ts here on the screen. Do involve your key employees. It's crucial for continuity, right? It's hearing a familiar voice on the phone when a client calls in, it's seeing a familiar face when they're greeted, maybe at the front desk. Having that level of engagement and support can make a huge difference in the successful transition of your practice, but make sure that you introduce your key employees to the successor at the right time and with the right message. Do create a detailed transition plan. Outline clear steps, timelines, processes, scripts, tasks that can be done by your firm, the buyer's firm, maybe outside consultants, or maybe your broker dealer or custodian. trying to get all of your ducks in a row and create a detailed transition plan just makes your life so much easier when you are trying to get clients to transition, right? Get documents signed, make sure that they're accurate. You're doing countless meetings to make sure that that transition process happens smoothly and effectively. If everyone knows prior to that go time what they need to do and how they need to do it, it just saves so much misstep, if you will. It saves so much heartache. So just try and be as detailed as you can prior to actually putting the plan into action. Communicate transparently and frequently. Keep a consistent message. Make sure that everyone's informed and aligned. Um, this is particularly helpful with buyers. So often sellers want to convey a certain message to their clients, and rightly so, right? They know their clients better than the buyer firm does. But it's important that the buyers know what your message is so that they can help share that message and there's not confusion for the clients or staff about what's happening or how certain things went down, right? Everyone has a clear and consistent message that they're communicating. Be complimentary of the buyer, right? The buyer's coming in, they need to earn the trust of clients and staff. And so do your best to make them feel confident and capable, reinforce their strengths that they're bringing to the table in front of the clients or the staff. Let them talk, let them share what they're good at, and let them execute on certain promises that are made, even if it's just like the buyer saying, "Hey, I'll, send you a follow-up email after this meeting." Let the buyer send the follow-up email so that they can get a check right next to their name, like, "Oh, they did what they said that they were going to do, and they did so timely." And do maintain client focus, right? Without the clients, you really don't have anything to sell. And the relationships here are strong. I mean, so many times I hear sellers saying, these clients are like family to me. I've had them for 20 years. I've gone to their child's wedding. Make sure that they continue to be the focus even as you transition the business out. Don't rush the transition process or let it drag on. Obviously, you want to make sure that you are focused, you're providing and giving yourself time, but make sure to avoid delays that can cause confusion or lose momentum. Don't neglect client communication. Make sure that they know next steps, and that communication is clear and transparent, like I said earlier. Don't assume that the buyer is going to handle everything seamlessly. Regardless of how many acquisitions a buyer or previous seller has done, there's always something different and unique that's going to come up, a different question, a different process. Heck, sometimes the broker dealer or custodian might change something along the way from one acquisition opportunity to the next. And so, just because you have everything buttoned down doesn't mean that things might not change. There's always going to be things that you're going to have to navigate, and you'll have to do so fluidly. Don't pressure clients to make quick decisions during the transition. Let them adjust at their own pace to ensure continued trust. If you, as the seller, have done everything that you needed to do, right? You've found that good fit, you've done your homework, you've done your due diligence, you're focused on providing a cohesive and successful transition, the clients will get there. Sometimes they just need to feel like they need to do their own due diligence, but honestly, your work, your thoughtfulness during this process will come across, and 9 times out of 10, the clients see that. And then don't underestimate the emotional impact of this transition on both yourself, your staff, and your clients. It's okay to acknowledge these feelings, but I think that when sellers get through this entire process, again, if they've done it right, the emotional impact is one of pride, one of success, one of happiness that they've made the decision and that they did it the right way. Um, that being said, we also want to discuss 5 things that you need to do to successfully retain clients and staff during the transition process. Because again, this transition process is crucial. You should, again, make sure to communicate internally or intentionally, excuse me. Keep your clients and staff informed about the transition. Make sure that they know the why behind the sale. Provide clear updates to everyone with next steps, processes, timelines. The more intentional you are about your communication, the more everyone feels involved and part of the process rather than like them thinking like, gosh, did they forget about me? What's next? Should I be looking elsewhere? Intentional communication is the key to success. Make sure to personalize things, right? Don't just say, hi, client, it's been great servicing you for 20 years. Take the time to address the letter with their first name, right? Make sure to set up meetings, address their concerns. Spend the time like you've always done to reinforce that this is good for them and that it will continue to be beneficial for their future. Have process and timeline transparency. The more clear you are about what you expect, what they should expect, and when will help avoid surprises and just make sure things seem as streamlined as possible. As you are engaging in the exit planning process, there's going to be a large level of things that you are seeking to maintain, right? In continuity, whether that is servicing continuity or fee continuity or broker dealer custodial continuity. All of these things that you're trying to keep the same, you should definitely share that. It just helps the clients and the staff realize how much you've done on their behalf and why this, again, is such a great thing rather than change, which seems maybe a little uncomfortable. You want them to be excited about this change. And then last but not least, highlight the benefits of the transition. Focus on the positive changes it's going to bring, such as new resources, expanded services, better growth opportunities. This will help the clients see that this transition is an opportunity, not a disruption. Dave, I'm going to kick it off to you to close out with post-sale observations.
Yep, perfect. Thank you. And just real quick one here, frankly, since I know we're getting precariously close to the top of the hour anyway, and luckily we only have one more slide. So the kind of redheaded stepchild, unfortunately, of deal making is taxes. It gets overlooked, obviously, not in deals that we work on, but in a lot of deals industry wide where people talk about finding the right fit, and they do. And then they negotiate and they get a good price. They figure out the terms and then they close the deal. And then a year later, the CPA looks at it and says, okay, Kristen, so you sold your business for $1 million. What exactly did you sell? Because I'm not seeing it in the documentation. It just says you sold and got paid $1 million. But I need to know how to categorize this and treat it because this could be ordinary income or it could be capital gains. I know obviously everyone listening wants to pay their fair share, in taxes, but not a dollar more. So what you see on the screen here is the average tax allocation just to plant the seed and get you thinking about this. When you sell, and let's just say my example, so I'll keep it simple. You sell for $1 million. 960,000 of it, or 96%, I'm rounding, of that $1 million would be paid to you and should be in the contracts, should be set up so there's no surprises post sale as the capital gains. And you can see here the label, goodwill, clients. Goodwill is the IRS term. It's a Section 197 intangible asset. But we're talking about clients and your reputation. Like it's the thing you have to sell that has value in most cases. But it's not 100%. And that's why we wanted to point it out. You see the other 2% up here split 2% to consulting, 2% to the restrictive covenants. This is part of the purchase price. So when you see multiples talked about, those multiples, the values being paid out there right now are inclusive of all of these things. I.e., I wouldn't pay you any money to buy your book of business if you're not going to transition the relationships and agree not to steal them back from me. So it's all sort of part and parcel of the deal. At the end of the day, it has a pretty big impact on both the buyer and the seller. So while we are talking about it in the context of post-sale considerations, what happens to you post-sale on taxes is as a result of the things you did during the negotiations and putting your deal together. So With that, I'm going to hand it over to Kristen. You can help close us out. And I don't think we have any time left for questions, but we got to a bunch of them organically anyway.
Yeah, I'll just have you advance through the slides a little bit, but I did want to address one question, which was, one person said, "What's the advantage of working with an investment banker to package the deal and request bids? Is an investment banker necessary? How would you handle this? What are the advantages or disadvantages?"
Yeah, investment banker, it gets used as kind of a generic term. Short answer is most of you listening do not need an investment banker, isn't even appropriate. An investment banker is really good at taking out and creating a market for your stock. So sure, if you're sitting here listening and you've got, 20 billion in AUM, your fee on the RIA, and you need to go get a PE investment and you want us to go shop a 20 or 40% stake as in create a market for your securities, your stock in your company, yeah, investment banker all day of the every day of the week and twice on Sunday. Like, we need the appropriate licenses for that. For literally the other 99% of you listening, it is you need an M&A broker. You need somebody who can represent the sale of your business. And again, I think our differentiating factor here, aside from the amazing client experience we'll create for you, is most investment bankers or even business brokers who do what we do, they will do the listing part, and then you get handed off to an attorney and they'll go try to figure out the contracts. Then you figure out your taxes. We just bring all that stuff under one roof. So most advisors, when it comes time to sell, they either need an M&A consultant because they're doing internal succession, or they need an M&A consultant to sell and list their business. If it's a big enough business and we're talking about selling off the shares in your company, a stake in the company, making an investment, then sure, an investment banker is actually the right tool. Otherwise, you got to make sure we have the right tool for the right job, right? Investment bankers are working in the multi-billion-dollar AUM space and above. Could they play in this space? Sure, but they don't have the experience, knowledge, or resources that you need. Just like we wouldn't be trying to take a 20% stake in a $20 billion AUM firm out to market because it's just not our area of expertise. So, anyway, long answer for a short question.
Thanks. And just to wrap up, as Dave said, if you do want the additional resources, today's deck, text SRG to 33777. Obviously, you can take pictures of the QR codes that are here on the screen. But again, if you get the deck, or if you follow up or our team follows up with you, we can provide you all of this and more. With that being said, our team, Sabrina, Nicole, and Craig, will be following up with you here shortly, probably this weekend next. Dave, if you can advance that slide to see their beautiful faces. They will be the ones. So please pick up the phone, talk to them. They're lovely to talk to, and you'll get some additional piece of information. With that, we appreciate all of your guys' time. Thank you for going over time with us, and we hope you enjoyed the presentation. We'll talk to you soon.